at which point I'd like to hand over to Simone Westhouse.
Thank you, Ivan, and good morning, everyone. So I will talk a little bit about our approach to investing in AIM at LGB. So it's always important when investing in any market that investors have a strategy or a framework that they can act consistently against. This is the only way to create a sustainable portfolio throughout market ups and downs, economic ups and downs, and it allows investors to generally ignore market noise. So this is true for institutional investors as much as for private investors. In many markets, it's sufficient to follow the market index, as this will provide a balanced exposure to business or economic sectors. For example, you could easily buy the FTSE 100 tracker. In the case of AIM, though, the index is not really representative of anything in particular. And indeed, as we have just heard from Ivan, it has changed significantly over time. So an index approach does not really work here. So what we do at LGB is we use a thematic approach. We have identified some top-level themes, which are digitalization, new age consumer, future of healthcare, and decarbonization. And within those themes, we're thinking around sub-themes, for example, clean energy, next-gen manufacturing, the Internet of Things, advanced diagnostics, just as a few examples. And we really think around companies in that context. The purpose of thematic investing is to be really at the forefront of technological developments and innovation and changes in the structure of the economy and society. AIM is a market for growth companies, and therefore it's a really good market to look for opportunities in this form of investment. Now, what happens is share prices rise when investors allocate capital into particular business sectors in anticipation of structural changes. For example, in the last year, we've seen significant money being allocated to clean energy and healthcare. And as a consequence of that, we've seen some really strong performances in stocks in these sectors. So as an investor, you want to be ahead of those trends and these capital allocations by institutions. So we will typically look for opportunities in companies with market caps between 20 and 100 million. They may still be under the radar of most institutional investors, but they will already have received some significant validation of their business model. So once you've identified some attractive themes, the next step is to establish an investment template or a set of criteria that can be used to assess individual investments. In our investment template at LGB, the most important criteria we think about is the quality of management and the company's business model. So we will typically look for companies that are helping their customers and business counterparties improve their productivity. So that means that we don't have to wait for them to build huge empires themselves, as it is likely that other counterparties will adopt their IP or technology and enable them to scale quickly that way, for example, through licensing deals or product adoption. We are not sector experts, but we look for businesses that have already received significant validation from counterparties who are experts in their fields. For example, the customers, the regulators, collaborators, peer reviews in the case of some new life sciences. So really proven business models. And finally, we rate recurring revenue business models very highly, as obviously revenues will become more predictable and visible. So the importance of these criteria is based on our recognition over the 16 years since we started our business, that no business plan survives contact with the market, and any strategy must be constantly assessed, as things always will happen that cause difficulty and present opportunity. The key predictors of success are how well a management team adapts and the strength of base on which they're operating. By nature of innovative growth companies, many AIM companies have management teams that are learning as they go. So we are looking for management that are able to really work as a team and regularly reassess the threats and opportunities which they encounter, as well as their own operational capacity. So then finally, when we have identified some candidates for investment, the next step is to focus on portfolio construction. And here, the two key factors are volatility and correlation. What we see in AIM is that share prices tend to be very dependent on RNSs, and most investors will have quite a short-term focus. So the difficulty with that is that share prices can be extremely volatile, and it's not uncommon to see share moves of over 10 or 15% in one day. But the positive of it is that there is not too much correlation between the stocks. So this is why it's so important to take a portfolio approach. So on this graph, we are showing a portfolio of 6 of the stocks we have invested in, with different themes. Some are in the same sort of top themes, but different underlying markets. And we're showing their movements over the last 2 years. So you can see that they are all moving quite independently. However, in the red, you can see how the portfolio has evolved over that time. And you can see that if you'd had all 6, you would have had a much smoother ride than if you'd had just 1 or 2. So if we look a little bit closer on the next slide, here is a table which actually shows the volatility of each stock. And you can see that the volatility is extremely high for these stocks, anywhere between 43% in the case of Crimson Tide to 129% on Futura. So it's a really high volatility levels. However, if you look at the volatility of the portfolio, it has come down all the way to 22%. So what that means is that the overall risk-adjusted return, which is the Sharpe ratio, is actually much better for the portfolio than for any of the underlying stocks. Thank you, Rosie. You can take that away now. So I also must, like Ivan, add a little bit of a health warning here, so that investors should not remotely make AIM the biggest part of their portfolio. It is important for any investor to keep a diversified exposure to different asset classes, including international stock markets, bond markets, property, etc. And the allocation here will depend on your overall risk profile. What we like to do at LGB is we like to include some short-term high-yielding fixed income securities to our portfolios through our medium-term note programs. So our programs offer regular opportunities to invest in secured fixed income securities, often issued by AIM-quoted companies. And we like to add these type of instruments to our portfolios to reduce the volatility further and add some liquidity as well. So this is what we call our barbell approach, and I would be happy to discuss that with any investor who would like to learn more about that concept after this webinar. So just to summarize the key messages I would like to take to investors to take away. So first of all, think around your themes, use an investment template consistently, and create a portfolio of uncorrelated stocks to lower your overall volatility. You will get a much more comfortable ride. Details will always change, but the principle is robust.